In this session, I would like to look at how we would be handling the non-recurring and non-operating items in the income statement. What do we mean by non-recurring items? What do we mean by non-operating items? And how are they looked at in the income statement? So, on a broader scale, if I have to look at these non-recurring and non-operating items, I can look at the discontinued operations. If the company has discontinued a few portions of the business, how would they be handled in the financial statement or in the income statement? Then we will talk about extraordinary items. What do we mean by extraordinary items and how are they handled in the income statement? Then we would also see a category called unusual or infrequent but not both. Unusual or infrequent but not both kind of items. How do I represent them in the income statement? Then we'll see the changes in the accounting policies, right? Changes in the accounting policies or standards. How are they typically reflected? And finally, I would also see what are these we call as non-operating items and how do we represent these non-operating items in the financial statements. So these are the different dimensions that we would focus in this session. So just getting started with the discontinued operations, one of the most important aspect in the non-recurring kind of items. So I would look at the discontinued operation. So whenever we are saying a discontinued, from the management perspective, they have planned, they have planned that a particular unit or the particular line of business or a particular geographic location, it would be shut down or a particular product. So management has planned that it is going to exit out of this, but not yet done, not exited. There is a plan for exit. I mean, there is a roadmap. Okay, within another 1.5 year, we are going to exit. So there is a kind of a roadmap. There is a planned date, which is typically called as the measurement date, the day on which the planning phase started, and this is actually the deadline. And during this period, this entire period, from the day the plan started and from the to the actual date of disposal, we typically call as the phase out period, right? So if the company has created such kind of a plan but it is not yet disposed, or it is disposed completely during the current year, during the current financial year, there is a disposing of that, but during this period there is some income. During this year it has generated some income or some losses, and so even that is treated as a part of discontinued. But one thing is, in both these cases, whether there is a plan, whether a plan has been in place but full disposal has not yet occurred, or disposal has occurred in the current year, in both these cases we treat that particular operation as a discontinued operation, and we try to treat it separately from the rest of the firm, right? So that we can very comfortably assess that in the future this number will not be there because it's already a planned discontinuement. So in the future we don't suddenly see a surprise in the numbers saying, okay, up to this year when this particular plant was included, this was the revenues and net income, but in the next year it has fallen. So it should not be attributed to the non-performance of the company. it should be purely looked at it because this particular business is discontinued. Now the comparison should happen with this portion in the financial statement. So that's the reason from all specific dimensions, the discontinued operations need to be treated separately only. So the way we represent them in the financial statements, so any kind of income, gain or a loss, whatever is coming in the discontinued operations, I will compute net of tax separately. The income, the expenses associated with this discontinued operations, I will compute separately, net of tax, and I will present it as a separate block. So, which means this is a continued operations block where I have revenues, expenses, and finally computed the net income. One more block I would create at the bottom, which is the discontinued operations block. Again, here I will have a separate revenue, expenses, and the net income. So the net income which we would be using for all practical purposes is this particular net income, whereas here we will show it, this entire thing will be shown as the discontinued operations block separately after the net income. The net of tax would be considered and would be represented. And at the same time, because we have to present comparative financial statements, so even the last years, I would restate it in this way only. Last year, I might not have discontinued this unit or operation, but because of the possibility to create a comparison, even for the last year's statement, I would restate only containing the continued operations and the discontinued operations being stated at the bottom. So that kind of restatement has to happen, right? And even for the past statement also, wherever we are providing the comparison, even there I will make the necessary changes so that comparison becomes more and more appropriate. So if there is any kind of estimated loss, right, on the measurement date, right, on the measurement date, which is the date on which the plan has come out, if I am estimating that some kind of a loss can come out because of that operations until during that phase out period, if any kind of loss is estimated, that entire loss can be accrued. So the whole loss is spread out during the phase out period. The loss has to be accrued during right from the measurement date itself. And but in case there is an expectation of the gain, until the real phase out happens, do not consider the gain. If there is a loss, show the estimated loss as a part of this on the measurement date itself, not until the end of the actual date of phase out. Show the estimated loss in the income statement on the measurement date itself, but if there is an expectation of the gain from it, don't show any kind of a gain until the actual transaction is completed. So in simple essence, any discontinued operation, the whole income or loss from the discontinued operation is shown as a separate block after the net income. So from an analyst perspective, it's better that he does not consider this block because this will not be existing after this period or at the max next period. Only this block should be used for forecasting, or this block only should be used for valuation purposes. So that makes the analysis more and more straightforward, right? So this is how a discontinued operation needs to be looked at. Then I will look at extraordinary items. Typically from the definition, when I say extraordinary items, something which is unusual in occurrence, it's not a regular thing. The definition is also pretty unusual, and it is even infrequent both. And it is infrequent, it occurs only once in a while, it's not a periodic occurrence. And even the event is completely unusual, it's not routine. So especially when I look at the examples like uninsured losses from natural disasters, generally the companies, they insure all their losses. But if there is a big natural disaster has occurred, which is not planned one, right? Regular natural disasters again might be planned and might be insured, but some specific unusual disaster has occurred and the insurance for the same has not been taken, so the amount is also much higher. The loss is unusual, it's infrequent, probably that kind of loss occurs once in a while, once in lifetime. So these kind of losses, we categorize them as extraordinary. Sometimes we pay off the debt, early retirement of the debt. Sometimes this may not be a usual operation of the bank or of any company. It's not a routine operation of the company, and it's an infrequent. It did not happen in the company till date. So that kind of a transaction can be categorized as an extraordinary item. Now, whenever these things are treated as extraordinary, even these extraordinary items, again, we have a separate treatment in US GAAP versus IFRS. In case of US GAAP, I will treat them separately below the net income. Just like a discontinued operation, I will treat the extraordinary items separately net of tax, just like the way I have handled the discontinued operations after the net income, net of tax after the income from the continuing operations. So this comes after this. So again, from an analyst perspective, he can completely ignore this block off. But from an IFRS perspective, there is nothing called separation. Both of them needs to be treated together itself. The operating results as well as the extraordinary items, both of them need to be treated in the income statement itself. So there is a change in the way they are presented in both. But simple way, even if it is presented here, the analyst can very well take his own assumption in terms of removing them from the analysis. But sometimes what happens is some companies, they keep having this number every year due to some kind of risk taking nature that is associated with those companies. They may not insure some of the losses, or they have more and more losses possibilities of occurring. So for those kind of companies, probably some retaining them is much more appropriate rather than completely ignoring. So some kind of judicial way of treating them is required from the analyst perspective. But this is how the extraordinary items get reported and evaluated in the income statement. Then the next dimension that we will look at is something which is unusual or infrequent. It's not both. When it is both unusual as well as infrequent, then we treat it as an extraordinary. But if it is only one of the two, we have a slightly different way of handling it, right? So it is either unusual or infrequent, especially sale of asset. I sell off some assets, it's unusual, and at the same time it may be an infrequent exercise but may not be unusual. I don't know when I'm going to sell off, but I may sell off once the asset is becoming older and older. So it's an infrequent. So whatever the gain or loss that I get on the sale of asset, will treat it as infrequent item. Impairment, okay, it's an unusual. Some assets which lose their value, I would try to reduce their value. Probably on an annual basis I am doing their impairment test, but very rarely they undergo an impairment. So any kind of impairments or write-offs, any loan, a big loan that I have given, but I've sold something to a customer on a very big scale, but I'm not able to recover that. I don't know when I would be recovering, so I may want to write it off. So which is more infrequent but not unusual. So these kind of various elements which are either infrequent or unusual, I am keeping in the income statement itself. In the income from continuing operations itself, it would be there, which is reported before tax. So typically unusual or infrequent items are shown before tax, and on the top of that the tax is computed and the net income is typically arrived at. So they are going to impact the net income. The unusual or the infrequent items are going to impact the net income. So probably the analyst may think of keeping them rather than removing them from the analysis. Some kind of a some kind of a percentage allocation or some kind of a pattern with respect to what would be the typical value associated with this unusual or infrequent items need to be understood, and the allocation be made accordingly. So that is how the unusual or the infrequent items get treated in the financial statement. Now, any accounting principles that are changed, right? A change to the accounting principles or standards or estimates, any changes that are typically coming up from the previous year to the current year. So if at all those kind of changes are occurring or some kind of errors coming up in the previous periods financial statements. So here there are three major things that I can look at: accounting principles changing. So when I say accounting principle has changed, the company might have moved from one accounting principle to the other. Probably the depreciation. It might have changed from straight line depreciation method to accelerated depreciation method, right? So now when it has changed from one method to the other, what is typically expected is, apart from explaining the reason for a change, there is a retrospective application. Means the prior period, whatever is the past period that the company is showing for comparison purposes, even that period's financial statement also need to be restated based on the accelerated depreciation method, not just the current years. So it has to be applied retrospectively to the past year's financial statement also accordingly, and the whole financial statement need to be restated. So that becomes that enhances the comparability. Otherwise some numbers unnecessarily go up or unnecessarily go down just because of a change in the accounting principle. So to promote comparability, it is very much expected that if there is any kind of such change in the accounting principles, it is mandatory for a company to restate the prior period's financial statement also based on the changed accounting principle. So that means that is what we call as retrospective application. But if at all there is a estimate change instead of principal change, if the company has initiated an estimate change, when I say estimate change, it could be as simple as a salvage value on an asset. Earlier they thought that the salvage value is 500 bucks, but now they are estimating that the salvage value is only 200 bucks. So if at all there is a change in the estimate regarding the salvage value, or probably if at all they are expecting a change in the useful life, Initially, they thought that the asset is having a 10-year life, but now they are feeling that it is not beyond 5 years. In this kind, these are what we are calling as estimate changes because of some kind of updated information that they have got. Their management came to a conclusion that keeping the estimate at the original value does not make any sense. They want to revise the estimate. So in this case, I don't need any retrospective application. It can simply be prospective application only. So whatever is left, whatever is the book value that is left, based on that, the new depreciation, the new depreciation or new value for the expense can be computed. But the past financial statements need not be restated again and again. So whenever there is an estimate change, I don't need to look back. But when there is an accounting principle change, yes, there has to be a restatement of the past. And in some cases, we also talk about a prior period adjustment, especially in the previous year's financial statements. If there is some kind of an error, if there is some kind of an omission in the last year's financial statement, or a wrong method being used for computation, any of these things happened in the previous financial year, I can make some kind of correction to the previous financial year and I can represent it. So if that is the kind of error that is there, then again the whole prior financial statement, the previous year's financial statement, that needs to be restated. Again, at retrospective application, they have to be completely restated, and the clear disclosure, what was the error and what is the typical effect on the net income. Last year, what was the net income when you ignored this, but now when you are replacing with this, what is the effect on the net income? So this part should be very clearly disclosed as a part of the footnotes. So these are some of the important things that come out, especially when some accounting standards change. But one thing in all these cases, one, the cash flow does not get affected. So that's one thing. That's a good thing for the analysts. The cash flows do not get affected. It's only the change in the values, the expenses, net income could change, and that's where we have to see whether all these changes are in real true, or is it because of some kind of manipulation that the management is really working out to. Because overall cash flows do not get impacted, but yes, some assessment with respect to the future net income, what is the kind of impact of this change on the future net income of the company, needs to be assessed properly by the analyst. And at the same time, if there are some errors and omissions in the previous, though the cash flow will not change at all, but it talks about the worthiness of the internal controls that are there in the company. How effective are the internal controls? Why are they not able to identify the errors? Why were there omissions? Why was the wrong calculation being used? So is the review process for stating into the financial statements appropriate or not? So that gives some kind of doubts regarding the effectiveness of the internal controls within the organization, right? Now, one important aspect that comes out is the operating component and the non-operating item. Operating item on the non-operating items in the financial statement. See, operating is primarily to do with the core business. And for a manufacturing firm, right, for a manufacturing firm, any activity that is relating to the production of the good and the service, that is mostly the operating part. So expenses wise, all the operating expenses are shown separately, and the non-operating, especially when I say non-operating, for a manufacturing firm, probably investment is completely non-operating. It tries to invest in some bonds, it tries to invest in some shares, so it tries to invest in some mutual funds. So this investment activity is completely a non-operating kind of an activity. Now, in this, it could receive probably some kind of dividend it could receive in those companies which it has invested, or it could receive some form of interest. So, these kind of receipts of income and these receipts of income, they are treated as a part of non-operating income itself. This is an income that is not coming from a regular course of business of the company. This is something because the company had some excess cash, it is simply doing the investment and it has got some kind of income on those investments. Similarly, there could be a few financing activities. It has raised the capital in the form of debt, so it is paying towards the debt. So probably the interest that it is paying for the debt investors, it's a part of the financing activity. It has nothing to do with the operations. Similarly, the dividend that is paying to the equity investors is again for the capital that it has raised in the form of equity. So these are independent of the operations of the firm. So we talk about all these components as a part of non-operating components in the financial statement. So whether they are income or expenses, they need to be shown separately from the operating component. These two should not be clubbed in terms of presentation. That's one more thing that we need to be careful of when we are looking at the different elements and accounts that are typically coming into a income statement. So that's how a special focus need to be kept on the non-recurring kind of items and non-operating kind of items, because they in some cases form a significant portion, but they have to be very carefully analyzed for doing an appropriate assessment of the financial health and even the valuation of the company, right?